liquidity runs in consolidations. The same thing applies obviously in trending conditions, because we understand that the market moves from a time and price theory. We're looking back 20, 40, and 60 trading days for our IPTA data ranges and referencing time. And for one shot, one kill or short-term trading, we focus primarily in the last 3 months for the most salient institutional reference points. We key off of, obviously, the PD arrays based on a premium or discount market, and we're looking to trade from one PD array to the next, ideally from a discount to a premium range that can be easily defined. Okay, for our case study for liquidity runs in trending conditions, we're going to be looking at the pound again, and this time we're going to be looking at a different fractal of the larger consolidation. So we're going to be looking at a smaller segment of this price action, and because price is universally fractal, what could be a consolidation on one time frame can be a trending environment in another. So we're going to add our PD arrays from the monthly, weekly, daily, and we're going to use this information in conjunction with the trending environment conditions that we use to trade from a low-end discount to a high-end premium market. In other words, we're going to be looking at an example of buying during a upswing or a trending bull market. Our case study is going to be focusing on this price leg here, as identified in the shaded area. And this is going to be our trending condition. Now, before we get into it, notice that we are originating the basis of that swing up from a deep discount market. Overall, the larger consolidation, we can see clearly that the market has found support, and because we're in a discount market, the market generally is going to want to move to a premium, either by a short-term basis, or intermediate-term basis, or a long-term basis. So since we're looking for short-term trades, we know that predominantly the market in the March time period is in a oversold condition. An oversold condition, or defined as we refer to it as a discount market. So the market's going to want to reach up into some measure of a premium. If there's a displacement and the market trades higher, we'll know that because the market is showing an aggressive nature to trade higher. And if that is being shown in price, then we know that institutions are funneling money and they're also building positions in that up move. Now, obviously, if they are building long positions and the market is accelerating on the upside, they're reaching for some institutional reference point where they can unload that long position at a profitable point. They have to find willing buyers at a higher level. So we have to look for premium PD arrays where willing participants in the marketplace will want to buy from a lower holding long holder, or in this case, smart money. Okay, for one shot, one kill, we're going to be dealing specifically with the 4-hour chart. Now, the 4-hour chart is, in my opinion, the easiest trading time frame for one shot, one kill setups, or how to frame that setup. Because it's my cup of tea, if you will, it's my forte, my go-to trading model. I have learned that the 4-hour chart can give us all the insights that's necessary for using all the details and components to finding one shot, one kill or short-term trading with high probability trading conditions. So by using a 4-hour chart, it's easier to frame a one shot, one kill or short-term trade in this time frame, because you can see with a simple couple clicks of your MT4 platform, and if your platform doesn't use this, whatever the equivalent would be, but if you hold down Control and touch the letter Y, it'll give you the day dividers. Okay, and specifically when you're in 4-hour, it's not giving you the daily dividers, it's actually giving you the weekly dividers. So every vertical dotted line here represents the beginning and end of a new trading week. When we look at price like this and we have the PD arrays on our chart, it's very easy to see where price will reach up to. Notice that we're also looking at this pair with the gradients shown across all of the discount and premium ranges. So we not only have the discount and premium range divided, then we have the upper portion divided, and then we have those smaller divisions in half as well. So we can see how the market has different levels of progressive premium and progressive discount levels. In other words, lower levels of discount and higher levels of premium. When we look at the 4-hour chart and we can see a PD array, for instance, a discount PD array, this could be in the form of a bullish order block, an old low, a fair value gap, a breaker, any of these types of PD arrays. If we're looking to go long, if that occurs or forms near a divider level or a quadrant level, as I call it, you'll be able to see high probability movement away from that level and then reach for an opposing level. For instance, if we look at the market in March 15th, where price had come down into the fair value gap, it also trades back to a breaker seen here. That move, trading to that level, gives us an ideal scenario to get long. We may have missed the entry at a lower level, but we can see this return to a breaker or fair value, and market explodes on the upside and trades higher. You don't need the absolute low in a bullish weekly close or up weekly range to be a one-shot, one-kill. You just need one setup that you wait for that makes logical sense, that gives you a realistic pip objective. And I think realistically, for starters, you should be looking for 30 to 50 pips a week, those types of scenarios, and then graduate into 50 to 75 and then 75 to 100 pips per week. I wouldn't try to go more than 100 pips, and I like to live in a 50 to 75 pip range myself personally, but you do to suit yourself. I just know that you're not always going to get big weekly ranges. Sometimes you'll get small weekly ranges, and it's going to be harder for you to get that 100 pip range if it only moves about 150 pips for the week. So you're going to have to really define a perfect entry and exit strategy to get that. I'm not saying it can't be done, folks, but just give yourself some flexibility on both ends, getting in and getting out. And so if you're looking for the lines portion of the weekly range, taking a portion of that is all that's necessary for your career. So if we look at the 4-hour chart, what we're doing is we're encapsulating the weekly range, and you can see this is the entire weekly range for this particular week, shaded in yellow. You can also see that the market reaches up into logical areas of premium PD arrays, and we'll cover that in a few moments. But look at this for a second and think about the power of 3 that I teach, where if the market's bullish, the open will be near the low of the range and the close will be near the high of the range. You can see that here. The market has a initial move lower in the beginning of the week, makes the low of the week, and then it explodes on the upside. It gives a few, not many, a few high probability entry points. If you miss the very low point, that's not a problem. Look at the 4-hour chart with all of the monthly, weekly, daily PD arrays. Now, obviously on the 4-hour, to keep this chart clean, I didn't add the 4-hour PD arrays. You can add them and you'll have more detail on this chart and you'll have more insights to trade off of. But to keep things germane and only on the higher time frame, we're just using the PD arrays from the monthly, weekly, and daily levels. And the subsequent week is seen here. Same scenario. The market trades down initially, making the low of the week. And look at the response off of the divider between the total macro consolidation that we did and we discussed in the beginning of lesson number 5 for cable. That movement down into the midway point or equilibrium of the overall consolidation, that is a high probability level in itself. Now, if you don't understand how to break a range down or grade a range or a price swing, you're going to miss these types of moves. So you have to always look at the trading ranges that the market's trading in, look at the highest high and the lowest low in the form of the bodies, not the wicks, and define that. And then once you have that, that's like your master blueprint, if you will. And you start breaking that down because the algorithm is going to work within that range. It's going to go back to reference points based on time and price, where price is already traded, where it hasn't been traded to, and reference to time. So we're looking for that same move that originated in March 14th, going into the 15th, that low formed in cable that was in a discount market. The second week that's shaded in yellow here sees us reaching up into a halfway point of the upper portion of the total range, or in other words, half of the premium range that we defined by the daily chart in its larger trading range. It moves from one level of logical discount to another level of logical premium. It's very discernible. You can clearly see it. Just by just grazing over this chart real quickly, you're not going to get the benefit of looking at price like this. If you don't study it basically and see the reactions, how price is moving and gravitating towards how I've broken down the range, they act like magnets, if you will. There's a component to trading that people like to put on their charts. I used to trade with it as well. They were called pivot points, and well, they still are called pivot points to be honest. But they came from floor traders and pit traders, where they would do calculations based on the high and the low, and adding specific measurements to get the projected highs and lows and supposed support and resistance. Now, that was like a self-fulfilling prophecy, but when you look at the grades of a trading range or a price swing, it helps you really discern where the market has its highest probable support or resistance without really having a logical old reference point. Like when we do support and resistance, we look for an old level, we draw it out in time, and just because it did something back then, we expect it to do it again in the future. And you've seen how that's worked out in your own trading. It doesn't have any consistency. So you have to look at what the institutions are doing and look behind the scenes and what's the institutional order flow. So if we can grade a price swing from a premium or discount measure, we can see the market was clearly in a discount range in the 14th of March. So by trading down there, trading into the fair value gap that's shaded in green, the natural response would be see price trade higher. It does that. And then it starts finding new levels of support institutionally based on a discount PD array. In other words, we're looking for reasons to support price. Could be in the form of a bullish order block, fair value gap, a breaker, a mitigation block. It could be a old low or an old high. Once broken, now turning support. All those ideas, okay, lend well to supporting price going higher. And you start working towards a premium market intra week. The more we get closer to another level of premium based on defining your range and defining your price swing and grading it, it's breaking it down into quadrants and then splitting it in half. When the market reaches for these measures, okay, it's almost like a mile marker for the algorithm. It will reach for it and then give the participants at the bank opportunities to facilitate trade. If it breaks through a level, okay, and it trades right through it, you know that it's going to most likely reach for the next level up. Very rarely do you see any midway points between the grades that I've already given you here. In other words, the way we define the market, breaking it down and cutting the ranges in half, the way we did that in lesson 5, that's the same levels we're seeing here. So I didn't add anything new except for the shading of the yellow of the box. I'm just giving you the context behind the market and why it was doing what it was doing. Now, clearly, obviously, one would say, okay, well, this is obvious, armchair quarterbacking, it's hindsight. But if you go through the charts, it's the same thing happening almost all the time. So by having the theory behind why it's doing what it's doing, we can look for how each week this same component or element to one shot, one kill will repeat itself. Looking closer, we can see that each week that the market we trade is going to seek to trade from one PD array to another. It will trade from one quadrant to another with the least resistance. It can move from premium to discount or discount to premium market valuation. Now, the determination of whether it's going to move higher or lower is based on where we're trading at the time when you're sitting down in front of the charts. If we're in a premium market, it means we're really pushed up. We are into a logical area of where price has shown a willingness to sell off before. It's away from its lowest levels of historical buys or where old lows have formed. Basically how we framed premium and discount, which we've already taught in this mentorship. But when we have the levels on our chart and it's in a 4-hour basis, it gives us context. It tells us how we can anticipate the full weekly range, because these daily, or in this case on a 4-hour, it's a weekly divider. By hitting control and tapping Y, you get these vertical lines on MT4. What you'll end up doing is each week before the market starts trading on a Sunday, what you want to do is just load up your 4-hour chart, have your PD arrays loaded on there, and make notations on where you think price may logically reach up to when it's in a discount market, or where it may reach down to when it's in a premium market. By looking at where the PD arrays are in a 4-hour chart, it's almost like you can anticipate what the weekly range will do in a completed sense. In other words, what the market looks like after the week closes on Friday. And a good example or exercise in this case would be to do this every single week. Try to anticipate what the weekly range will look like. Now, you're not going to get this all the time. It's not going to be perfect, and many times you're not going to be close to it at all. But what it will do is it will help build your anticipatory price skills, which is necessary to start seeing this stuff before it happens. We're trading in probabilities. We're looking at a statistical edge that the market, if it's in a premium, it's most likely going to want to trade lower. Where does it trade down to? It's not just looking for a support level. It's looking for an old area of institutional order flow. Where was their old buying? Where was their old institutional order flow seen in the marketplace? And it's going to be in the form of a PD array. So we look at our PD array matrix, determine what are those PD arrays that exist in your chart at the time, and you look at how reasonable it is for it to reach down into or up into that level between the two vertical lines. You only have Monday through Friday. Well, Sunday's opening until Friday. So you have an element of time that you have to work within. So because it's relatively short term in nature, it's easy to predict where the market may go between a Monday and a Friday. And you don't have to have the highest high and you don't have to have the lowest low. You just need to know what's the probable direction and what levels will it most likely key off of. That's the benefit of using a 4-hour chart and using the PD arrays from the monthly, weekly, and daily, and 4-hour if you want to have all that on there. But nonetheless, if you key off of daily, weekly, and monthly PD arrays on a 4-hour chart, you're going to get the highest probable trade reactions, and that's where the institutions step in. Now, when you refine it down to a lower time frame, obviously in an hourly chart, you get more detail, you get more opportunities to reduce the risk, and you might get another opportunity if you miss the overall daily or weekly PD array. In other words, if you miss that entry, it may give you one more shot to get on it with an hourly chart. But it's better if you just train yourself to work off of a 4-hour chart and start to envision and kind of more or less predict what the weekly range is going to look like. Here's an example here where the market trades down into the fair value gap. We're in a deep discount market. And for that week, it trades up into a bearish order block. The subsequent week, we have the price trading down into the equilibrium price point of the total macro range from the daily chart that we showed in lesson 5. And it also trades back down into an old bullish order block from the previous week. And then the market trades up and closes in a fair value gap seen back in February. Now, taking this information and refining it even further down into a 60-minute chart, you'll start to see a little bit more definition in the market. And looking closely, you'll see that there are many times you'll see breakers and mitigation blocks that didn't exist on your 4-hour chart. So anything less than a 1-hour chart, when you're looking for one shot, one kill, really reduces the effectiveness, because what you're looking for is that impulse price swing to help facilitate the weekly range or complete the weekly range. Anything less than a 60-minute chart, you're really just day trading or you're scalping. So that's why you want to focus primarily on a 4-hour chart for the levels you want to key off of. But once you get down into an hourly chart, then you can break the market down into a day-by-day basis. And then we can start incorporating day-of-week phenomenon. So if we're looking for a bullish market, moving from a discount market to a premium each week, what we're looking essentially for is the low of the week to form between Monday, Tuesday, and Wednesday. They are the highest probable trading days in this environment. So the criteria is, in a trending environment, we expect price to trade from a discount to a premium. In this case, we would reverse everything if we were expecting lower prices from a premium down to a discount market. But we have all our PD arrays on our chart and our levels and our quadrants on. So we have all of our natural support and resistance, which is the grading of all of the levels that we did in lesson 5, and then incorporating the actual PD arrays in deference to the IPTA data range of the last 60, 20, and 40 days. The low of the week in bullish conditions in trending environments, we look for the Monday, Tuesday, or Wednesday low to form. In the first week, we see here Monday, Tuesday, and Wednesday. The low forms on Tuesday. Notice the low forms off of a logical PD array in a discount fashion. Trades down to a fair value gap that's seen on the daily chart. So price trades up, creates a high that's slightly higher than Monday's high on Wednesday, and then breaks through it and creates a higher high for the week. So the intra-week high is formed on Wednesday. Notice on Thursday, it trades down into the fair value gap, into a mitigation block also from Wednesday's intraday trading. And the market does what? Another impulse price swing higher. All the way into Thursday, it goes into consolidation. And then Friday, it has a small little Judas swing, trades down into equilibrium, and then expands on the upside going into the close. The second week or subsequent week in our case study, we see the low forms on Monday after it hits the equilibrium price point of the overall macro consolidation as we defined in lesson number 5. And then Tuesday, we have a retrade back down into that same old low. So we had another retouch of the equilibrium price point, and then acceleration on the upside. And then Wednesday, we have another opportunity to get long, trading off of a breaker that's formed on that week's Monday. So we have Wednesday's trading down into a breaker, bearish, a bullish breaker formed on Monday's high. Wednesday's low is formed off of that, trades higher. And then notice also, while we had slightly bullishness on Thursday and then a relatively flat close on that week's Friday, one of the things I want you to see is when we go through this process, you're going to quickly learn that typically the weekly ranges, they have a 30 to 50% of the weekly range completed between Monday to Wednesday. In other words, by London close on Wednesday, 30 to 50% generally the range is completed. So what does that mean? If we have the willingness to look for longs only, we expect the market from a discount to a premium to unfold for the week. If we do not capture the long, either Monday, Tuesday, or Wednesday, and it has happened to potentially form, and we've seen some price action to suggest that weekly range is going to be up close or bullish as we expected, but we didn't get the trade on. Maybe we were stopped out. Maybe we missed it altogether. Or maybe we were wrong and we found out later in the week that, oh yeah, this is probably what's going to happen now, because that's going to happen as well. You may expect something to unfold for the week, and then it doesn't do that. And you have to be flexible and change gears. And we're going to talk about that in lesson number 7. But if you've missed the Monday through Wednesday phenomenon and the market's already traded, just know that it's important not to get pip drunk trying to get a lion's portion of a move by Friday's close, because the weekly range may end up being smaller or less volatile than you've anticipated. So just know that generally a third or half of the weekly range is done by Wednesday's London close, and don't expect a massive move higher or lower in the last 2 days of the trading week. Generally, if you get an explosive move, usually on Tuesday or Wednesday, Thursday may see a little bit of follow through, but then Friday has either retracement or it does what you see here in the second week, where it's basically a neutral close. It doesn't really do anything more stunning than what was seen in Thursday or Wednesday's trading. So we're going to build on the idea of this and incorporate how to know when there's going to be an intra-week reversal. So until next lesson, I wish you good luck and good trading.